All right, welcome back to Yahoo Finance Live. We are joined now by Jim Bianco. He is the president and CEO of Bianco Research. And Jim, we've had a lot of Fed news in just the last couple of days. There's a lot to digest here, but I guess on this Thursday, as you see what the Fed has done over the last several days, what's your read on where the Fed is at this point?
Um, you're right. We've had probably a decade's worth of news from the Fed in the last 2 or 3 days or so, including announcements from the Fed at 11:30 last night and 1:30 in the morning from the ECB. They're going 24/7 on this. The bottom line is the credit markets, the bond market remains somewhat dysfunctional. It's not working properly. And the reason is everybody's trying to sell, everybody's trying to get out. They've piled in all of their securities to the banks. The banks can't take any more. And the Fed is trying to find room for them to make markets at this point. It's very difficult for them. That's why you've seen all this Fed news. I think the bottom line with this is while the Fed is trying to get liquidity back into the financial markets, it's because prices, I hate to say it, are still too high and everybody wants to sell. So the minute that the banks get the ability to make a market, here comes nothing but orders to sell back to the banks, and then they're full again and they have to stop one more time. So it's probably going to take either lower prices to fix this, or it's going to take a feeling that we've got our hands around this issue. I like to say, if you don't give me lower prices, give me 2 million tests, because 2 million tests might be able to define the problem, and then we could stop thinking that it's a worst case scenario.
Well, and so Jim, that kind of gets to my next question, which is just from a sentiment. I mean, some people have said sentiment doesn't even matter in this market right now. But as you are examining things, what do you need to see to start to be a little more constructive? Because you're right. Anytime that there's any kind of organization in the market, I mean, yesterday, clearly that's just people coming in and selling everything. It's a washout across the board. What do you need to see for this, market to repair itself and for people to not be so scared?
If you want me to be perfectly blunt, 95% of the people that are reaching out to me are telling me that they're buying. Oh, this is a good time to buy. Buy to buy, 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 buy. No one's sending me texts to say that it's a good time to sell, and nor have they for the last couple of weeks. As soon as the people start saying, oh, that's it, it's all over, all hope is lost, then maybe we could find a bottom at this point. Instead of, everybody pretending that they're Bill Miller, thinking that they're buying, that this is the greatest buying opportunity of a lifetime. It may turn out to be that. But with everybody still thinking that way, it suggests that there's really not enough selling that's gone on yet, even though it has been a historic decline by most measures.
Jim, it's so funny that you say that, because at the beginning of the show, I was just saying that the family and friends calls, and I'm not a professional, you're a professional. The texts and social media and calls are all about when should I buy in this market right now. People think that they've already written this down here, and I think that it's interesting that you are sort of seeing the same thing. So what do you need to be looking at, do you think? I'm just looking at things that you've been writing about. There's oil, there's the leverage loan area. What is it? You say the Fed's done a lot of stuff, a decade of information here. What area of the market do we need to concentrate on the most right now?
I think at this point, within my bailiwick and within the credit markets as well, I think it's the Treasury market. I think that if you've noticed what's happened with interest rates, Treasury interest rates, the 10-year interest rate, the 30-year interest rate, they're going up. They should be, what the Fed did and what the stock market's doing now, those interest rates should be at zero right now instead of rising. And the reason I think that they're rising is it's part of the dysfunction in the market. It's the thing that people can sell. There's also probably a little bit of fear that on the back end of this, we're going to see a budget deficit that is going to be incomprehensible on the other side to pay to get this economy moving again. And that's probably bothering the bond market as well, too. And the third thing that might be bothering it is the Chinese have $1 trillion worth of securities. They got to get their economy moving, and they might be willing to finally sell them to get their economy to move as well, too. So I think if we were to see the bond market start to behave more normally, and that is that on days when the stock market falls, yields go down. On the days the stock market rises, yields go up. That would be a sign that something is returning to somewhat normal. But this relentless rise in yields that we see, no matter what's happening with stocks or everything else, is still a signal that you can look at and say something is still not right in the markets, and we're not there yet.
All right, Jim Bianco with Bianco Research. Always appreciate your commentary, and we'll talk to you soon.
Thank you.